Good afternoon and welcome to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is David Deull, as a senior economist with a focus on U.S. macro and consumer economics with our friends over at IHS Markit. Thank you very much for joining us here today. And the question is, are you ready for tax time? Is anyone ever ready?
It's everyone's favorite time, right? Yep, so the deadline's coming up. It's April 17th, and taxes are on a lot of people's minds. And add on top of that the fact that we've got this big tax bill that just came in December. Now, what does it do, really? And what doesn't it do? Well, the first thing to keep in mind is it doesn't apply retroactively, which means that if you're filing your taxes this year and you're looking at what your refund's going to be, it's not going to affect any of that. So that's kind of as normal. What it does do is, well, it takes effect in January of this year, so it's going forward, and it does different things for individuals and corporations. So on the individual side, most of these provisions are temporary. They're going to expire in 2026. On the corporate side, most of these provisions are permanent. They're never going to expire, so we're stuck with them. So on the individual side, the most obvious and the biggest effect is that it moves around the tax brackets a little bit. It lowers the tax rate, the marginal tax rate for most of those brackets. It also repeals the financial penalty of the Obamacare mandate, and it also changes some of the deductions and the exemptions that you're allowed to claim, including putting a cap on the exemption for state and local taxes. It does some other stuff too. On the corporate side, it lowers the corporate tax rate. It produces a tax holiday for repatriation of foreign earnings. It ends the corporate alternative minimum tax, and it also produces some incentives for business investment, but like expensing and so on for equipment.
All right. So, I mean, the obvious question is, what's going to happen with refunds this year? Will it be impacted by the new tax act?
Right. So, as I mentioned, this year, no. Mm-hmm. Next year, most definitely. But so this year, we do. At IHS Markit, we have a daily tracker. We keep an eye on the Treasury data coming in to sort of get a feel for what the tax refund season is looking like. And even though the tax bill doesn't affect it, this year's looking really strong. The last 4 years, refunds have been the biggest yet, and this year's no exception. We're looking at $301 billion refunded to consumers in a pretty concentrated period of time, including the biggest one-day refund ever of $60 billion on February 22nd.
Oh, wow. That should be good for the consumer sector.
Oh, it should.
You would think that money would go back to work and to the economy, but the question to people with their take-home pay, how come it went up?
Right. So it wasn't refunds, but it did happen, right? So how does that happen? Well, you had a couple of showy businesses doing bonuses, mm-hmm. Which the government estimates was probably about $30 billion total, which is about $200 per American worker. The major amount of take-home pay increase is going to come from withholdings, which is where your employer will take out a smaller amount of your paycheck every month or every 2 weeks because the government's reduced the taxes. So the smaller withholding is what translates to the more take-home pay. Now, how much? If you're a single filer earning about $25,000 a year, you're going to see about $25 extra every 2 weeks. Whereas if you're earning $100,000, you're going to see more. You're going to see about $120 extra every 2 weeks. But it's far from even. There are winners and losers.
Right.
So let's talk about the winners. Starting in 2019, that's going to be most of the tax brackets. However, as those provisions expire, and the individual ones do expire, that's going to fade away. And we'll end up in a situation in 2026 where it's really only people earning $100,000 or more who are seeing lower effective tax rates. Now, on the loser side, after that expiry of the individual provisions, we're now looking at pretty much everyone earning less than $75,000 is actually going to see a higher tax rate. There's also other exceptions. This is very complicated. It all depends on your individual situation. But if you're living in one of the 13 highest tax rate states and you own a lot of property, you might actually see a higher increase in your effective tax rate because you can deduct less of that state and local taxes.
Right. Well, we heard a lot of complaining about that in New York for sure. So,
yeah. Well, that's state number 2.
Yes. And so to wrap up, what are the macro level effects of the tax reform and the budget bill?
All right, well, so at IHS Markit, we do a lot of analysis and simulation on the macroeconomy, and so we took a look at this one. And so in the short term, you will see an increase in gross domestic product growth. We're looking at between 0.1 and 0.3 percentage points a year.
And that's
faster.
because of more consumer spending?
Right, so that's consumer spending, that's business investment to a large degree. It does lower the unemployment rate a little bit, although it's worth noting the unemployment rate's already below what's called the natural rate. So we're sort of humming along economy-wise. In addition to those benefits, it will increase inflation and it will significantly increase the budget deficit. Now, that's coming at the same time as we had this large budget, the Bipartisan Budget Act on February, which was a spending bill that was a lot larger than people expected. So that's kind of a double whammy of fiscal stimulus coming at a time when the economy is doing pretty well. So the short story is things are good right now, running on momentum. There was a little bit of a lull in the first quarter, kind of a hangover from really solid growth in the fourth quarter. But we're looking at 3% growth for the rest of the year at least. But this fiscal stimulus does raise the threat that maybe we might be entering a boom and bust scenario. If inflation goes way up, the Federal Reserve has to raise interest rates and it brings the expansion to an end.
Right. It sounds like they're kicking the can down the road, but we're going to have to come to terms with this huge deficit that's been created because you're cutting taxes and you're increasing spending. There's the disparities there somewhere in between.
Right.
All right. Well, thank you very much, David, for joining us today at MarketSite.
Oh, my pleasure.
And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.